For anyone who thinks of getting involved in the art of investing, the first thing that comes to their mind is the infamous stock market. I'm sure you've heard about it a million times from friends, family, and social media showing you ads of how profitable investing in stocks can be. Have you ever wanted to try it out? Have you ever had the thought of investing your savings in individual stocks? In today's online world, earning profits while sitting in the comfort of your home is a dream to a lot of people. With a combination of skills, experience, and luck, individual stock investing can lead to this dream. However, it carries its downsides and can be very volatile and dangerous. The best alternative to this would be investing in index funds. Index funds are constructed to follow a market index such as the S&P 500 index and therefore carry a significantly lower risk, while at the same time providing consistently good annual returns. But before we start talking about index funds, let's look at some of the major reasons of why you should stay clear of individual stock investing. Number 1, it takes a lot of time, expertise, and objectivity. Investing in individual stocks without the time or training necessary to perform basic research and analysis rarely leads to success. Analyzing stock picks is generally reserved for trained fund managers, brokers, and financial analysts at large institutional investment firms. These people have cutting-edge investment tools at their fingertips. They also have the time and know-how to read earnings reports, SEC filings, and other crucial information in the process of making an investment decision. Plus, and perhaps most importantly, institutional investors are the first to get the information they need about a company to make investment decisions. And once vital news about a company is released, they have the systems in place to instantaneously react to it. In other words, as individual investors, the cards are stacked against you. By the time you have enough information to act, the stock price has already been adjusted by the institutional investors working within the market who know more than you do. Another thing to consider is that many investors are blinded by emotions, which prevents them from making objective buy and sell decisions. When this happens, it becomes harder to see the red flags along the way telling you that it's time to sell. Number 2, it costs more. Every time you decide to buy or sell a stock, it's going to cost you in commission fees. Depending on your broker, these fees can range between $3 and $8. While that may not seem like a lot of money, it can add up quickly if you own a lot of individual stocks and are making frequent trades. One big downside to this, aside from the expense, is that you may think twice before selling a stock in order to avoid the transaction cost. You might end up holding onto an investment that's declining in value longer than you should be, thus compounding your loss. Number 3, there's a greater risk of loss. With individual stock investing, it's extremely hard to get this kind of diversification you need to offset your losses. The biggest reason why managed funds like ETFs and mutual funds have less fluctuation in value compared to individual stocks is that they're generally invested in lots of companies. So even if the price of one stock plummets, the fund as a whole remains stable. They also have less trading activity, which keeps transaction costs low. Alright, so now we're going to talk about index funds. Investing in index funds has long been considered one of the smartest investment moves you can make. Index funds are affordable, enable diversification, and tend to generate attractive returns over time. Let's explain a little to help you understand the basics. Here are some reasons why you should invest in index funds. Number 1, broad diversification. The most obvious benefit of investing in index funds is that your portfolio becomes instantly diversified, minimizing the likelihood of losing some or all of your money. A diversified portfolio can be compared to not putting all the eggs in one basket, which in turn significantly lowers the risk of losses. Consider an index fund that tracks the S&P 500. This index fund would hold about 500 different stocks. While the performance of each of these 500 stocks fluctuates over time, investing in a fund that holds all of them matches your portfolio's performance to that of the index itself. Diversifying your portfolio among so many companies by investing money into just one index fund ensures that the value of your portfolio is not overly correlated with the fortunes of any one company listed in the index. Number 2, low costs. Another major benefit of investing in index funds is that the cost, including taxes and management fees, may be lower than those associated with other types of investment funds. The first cost to consider is the management fee each fund manager annually collects. Actively managed mutual funds have expense ratios that often range between 1% and 2%. Most of that fee pays for portfolio managers to make buy and sell decisions in an attempt to outperform the overall market. Index funds, by contrast, are passively managed. Since they simply track an index by buying and holding all of the stocks in that index, the holdings of the index fund rarely change. The expense ratio is comparatively low because there's little work required of the index fund manager. Index funds' expense ratios typically range between 0.05% and 0.07%, and some index funds have expense ratios as low as 0%. If you hold $1,000 in index funds with 0.05 expense ratio, then you would pay just 50 cents as the management fee. The turnover ratio measures the percentage of a fund's holding replaced in a single year. For example, if a fund invests in 100 stocks and 10 are swapped out this year, then the turnover ratio is 10%. Naturally, index funds have a lower turnover ratio than actively managed funds. Index fund turnover ratios are usually about 1% to 2% per year, compared to 20% or higher for some actively managed mutual funds. If a fund sells a stock for profit, then the difference between the initial purchase price and the final sale price is considered a capital gain. Funds with higher turnover ratios accrue capital gains more frequently, which results in more taxes owed by the fund's investor. This isn't as much of a concern with index funds, though, thanks to their low turnover ratios. Since fund managers aren't selling stocks all the time, there aren't often capital gains to pass through to shareholders. Number 3. Attractive returns. The world-famous investor Warren Buffett made $1 million bet in 2008, claiming that the S&P 500 index would beat a group of hedge funds over a 10-year period. 10 years later, the results were clear. Buffett won the bet by a large margin. As Buffett knew that when he made his $1 million, even the smartest and most diligent portfolio managers can rarely steer actively managed funds to beat index funds. Only about 23% of actively managed mutual funds outperformed the S&P 500 over 5 years, according to research by Standard & Poor's. Individual companies both outperform and underperform the market, but in general, the overall stock market increases in value over time. As a result, index funds yield generally higher returns for low cost, which makes them an excellent value for any investor. That wraps up the video. I hope you enjoyed it, and if you did, make sure to give it a thumbs up, and I'll see you next time. Till then, peace out.